So I think the first thing to recognize is that when it comes to the potential for a pullback, effectively we are due. The largest peak to trough pullback that we've seen in the S&P 500 so far year to date is a mere 4% versus a long run average of more than 14%. And so when I think about volatility, volatility to me, rising volatility, just represents a wider distribution of potential outcomes. And I think that that's what you're seeing investors grapple with in the current environment. Not only are they worried about the potential for both infrastructure packages to be passed, not only are they worried about the debt ceiling, they're concerned about the Fed and what the dot plot this week might signal about the future trajectory of rates. And then you have Evergrande, which is very much the icing on the cake. And so, I think it's difficult to pinpoint any one thing in particular, but I do believe that we're in for some chop here over the course of the next couple of weeks. That said, despite some of the cuts we've seen to earnings guidance as of late, the picture for 2022 still looks very strong, and we remain constructive on risk assets over the course of the medium term.
Okay. Chris, I want to get your thoughts basically on the same question, given the fact that you are more geared toward growth with your funds. I mean, it is decidedly risk off in this market right now. You have the NASDAQ also dipping below its 50-day moving average, a key technical level there, too. Are you a buyer on the dips right now?
So days like today are days when we're very happy we have a cash position. We can pick away at those companies that we've been doing diligence on. And when we get opportunities where they sell off $3, $4, those are opportunities. We do think risk assets are the place to be longer term. We've been preparing here in the last month that we thought we'd be into a higher volatile period, seasonally as well as going into earnings season. Delta, variant has certainly impacted chip shortage, so supply chain, China. All these are significant risks really near term. But when we look out over the next year or 18 months, we still find very good opportunities in a lot of those sectors to deploy capital. So, we would be more of a buyer on a day like today. It's not the time to panic and sell.
Interesting. David, we got 10 million job openings in this country. The consumer continues to spend. Delta hasn't really rocked mobility or in terms of retail sales look pretty good. And we might get young kids vaxxed in the next few months. I wonder, is your playbook still one of a growthy economy where the Fed has the room to remove accommodation?
So I think that it needs to be. And I think, when it comes to the Fed specifically, and I'll move on to what it means for asset allocation in just a minute, I think we need to continue to differentiate between tapering and tightening. It is more than appropriate for the Fed to begin removing the punch bowl here over the course of 2022 more broadly. You look at the financial markets, you look at the housing market. I don't think that asset purchases are necessarily needed to the extent that they've been in play over the better part of the past year. And so, even if the Fed pulls back here a little bit, I actually think that it continues to be good for risk and for the reflation trade more broadly. We've kind of stuck to our guns here over the past couple of months as growthier sectors of the equity market have come into favor, and we still think that there's room to run in things like financials, things like industrials. It's not just an interest rate story to us, but really the idea that because we haven't seen this big surge in economic activity as we've moved past the pandemic, we can arguably have above trend growth for longer, which historically has supported those more cyclical parts of the market relative to those growthier ones. But we recognize the amount of uncertainty that continues to exist, particularly around the way that the consumer is going to evolve here over the next couple of quarters. And so we don't want to be completely over our skis in risk. We want to pair that cyclical exposure with very high quality exposure, because we think that the names that are the biggest risk in the current environment are those that have relied purely on the multiple to drive returns. Higher interest rates are going to impact valuations. And so right now for us, it's all about following the earnings.